Just recently, the cumulative net flows into ETFs have surpassed mutual funds, which as a whole, newly created ETFs are rising rapidly, where newly created mutual funds are actually on the decline. And crazy enough, BlackRock sees active ETFs more than quadrupling to $4 trillion by the year 2030. Now, after recently creating a video in great detail on the differences between index funds, mutual funds, and ETFs, I decided to dedicate an entire video to covering the tax efficiencies between the two and why you may really want to consider ETFs, especially actively managed ones, in taxable accounts over mutual funds. Which, if you didn't know, mutual fund investors can face unexpected tax bills even when a fund's value declines, because taxable distributions may still occur when the fund manager sells appreciated assets. All this means is that if you don't sell your mutual fund, you could still have capital gains triggered, and an example of this was just recently when Vanguard created big tax bills for target date funded investors, triggering thousands of dollars in surprise tax bills, where investors who own the funds in tax-advantaged accounts did not face the same tax consequences. So knowing that, before we get carried away, let's first go over how ETFs and mutual funds are structured. Now, both ETFs and mutual funds are a type of investment fund that allow you to track hundreds to thousands of different investments all within one purchase. And so for mutual funds, when you buy this type of fund, they are going to be traded at what's called the net asset value, short for NAV, which is the fund's price per share that is calculated once per day after the market closes by taking all of the assets in the fund, using the closing market prices of the underlying securities, and subtracting any liabilities, which is typically the expenses to operate the fund, like management fees, and then dividing that by the number of shares outstanding. This is exactly why when you go to buy a mutual fund, the trades will only go through once per day after the market closes, unlike ETFs that trade like stocks throughout the day. And so because of this structure, any time that a mutual fund sells a stock inside of the fund, that's typically going to be a cash transaction, which can trigger capital gains that are distributed to you, the investor, even if you don't sell the fund yourself, creating a taxable event. Now, it may seem confusing for ETFs, but to simplify it as best as I can, an ETF stands for an exchange traded fund, and this was given the name because ETFs are listed and traded on stock exchanges. Where a popular example here is Vanguard's S&P 500 ETF VOO that is listed on the New York Stock Exchange. Where if we look up the Vanguard's S&P 500 mutual fund with the ticker VFIAX, that is traded as a mutual fund and not listed on a stock exchange, which is why you're gonna have to purchase it through a particular brokerage firm. But with ETFs, because they are listed on stock exchanges, you can purchase them on nearly any platform and trade them throughout the day, similar to stocks. Because of this, rather than the mutual funds that trade at the NAV price, ETFs will still show what their underlying NAV price should be, but the actual price that they trade at is the market price, similar to stocks, that is determined by investor supply and demand toward buying the investment. All in all, because a mutual fund trades at the NAV price, it is a more accurate representation to the exact price of the underlying holdings, but for a highly traded ETF like VOO, the difference compared to the NAV price is extremely small and you wouldn't even notice a difference. But do know that with ETFs, they have market makers that are also referred to as authorized participants, short for APs, that act as the middleman, which an example here is that just recently Goldman Sachs was named the authorized participant on BlackRock's Bitcoin ETF. And so their job is to ensure that the ETF is trading efficiently, as close as it can to the true NAV price, but also to assist in the structure of creating and redeeming shares when the underlying holdings in the fund need to be changed. This structure is what allows an ETF to have a shelter for investors so that it minimizes the risk of triggering unintended capital gains. So to summarize the difference here, mutual funds are typically structured in a way where the transactions for the underlying holdings are done through a cash transaction, which is a taxable event that forces every investor in the mutual fund to pay taxes on any of the capital gains triggered. Where with an ETF, they are typically structured in a way where the transactions for the underlying holdings are referred to as an in-kind trade. That means the shares are exchanged rather than sold for cash, which results in no sale on the underlying asset, allowing this to be a non-taxable event, where there's typically going to be no capital gains tax since no assets were sold. With that said, let's now go over the key differences in tax efficiency. The first interesting article I found by Morningstar shows that of the mutual funds with the highest capital gains distributions last year, most of their counterparts distributed no capital gains. And so between similar ETFs and mutual funds, only 4% of ETFs triggered capital gains to investors, where for mutual funds, it was 26.5%. And then another study by BlackRock shows that with index and active mutual funds, the 5-year average capital gains distributed range from 2.5% up to 3.2% depending on the turnover, where for index and active ETFs, the average 5-year capital gains distributions are from 0.2 to 0.1%, where the turnover really doesn't matter here. Now, like I was saying earlier, the difference is even greater and much more noticeable among actively managed funds, because if you invest into a simple index fund like the S&P 500, the amount of turnover is significantly lower, and just to give you an idea, in 2024, only 12 companies were removed, while in 2023, it was 15 companies. And then another study by JP Morgan stated that ETFs, both passive and active, consistently distribute significantly fewer capital gains to shareholders than active or passive mutual funds due to fundamental differences in how they are structured and trade. Which below you can see a visual on the weighted average of percentage capital gains distributed per net asset value, and that actively managed mutual funds are the worst, with index mutual funds thereafter. So what the report is saying is that the average index mutual fund is also less tax efficient than either type of ETF. But I will say for index mutual funds, if you have significant gains in a taxable account, it's probably not worth switching over to ETFs and triggering the taxes. But if you have the choice going forward, at least what I like to do is just stick with all types of ETFs in taxable accounts, and then if you like certain mutual funds more, to stick with holding those in tax-advantaged accounts. Besides that, another study from Morningstar shows the percentage of funds with capital gains distributions across different investment styles, and that ETFs are the most effective for stock funds, where the average is significantly higher for mutual funds. But something really important to understand is that any income that you earn, whether that be from dividend stocks, funds, or bonds, that income will be triggered towards your taxes no matter if you reinvest them or not, but more on that later. Now, before I give you my final thoughts and strategies going forward, let's now go over a few real-world examples. The first to mention was from a Morningstar study published in 2024 that showed one of the biggest differences was if you owned the actively managed fund by Fidelity that has the ticker of FMEGX, where this fund would have triggered an 11.4% capital gain. This means that if you had $100,000 invested in this fund in a taxable account, that you would have triggered an $11,400 impact on your taxes, which you also have no control over how much of that is triggered toward short-term or long-term capital gains. Which, looking into this further on Morningstar, you can see exactly where the capital gains have come from, where the main difference we're going to look at is short-term and long-term capital gains, where at least for this scenario, majority would have been triggered toward long-term capital gains. But either way, this is a huge tax drag, and say that you had to pay 15% long-term capital gains on that amount, that'd be roughly $1,700 going to the IRS, and that also means that your initial $100,000 investment, to keep things simple and just say that it stayed at $100,000, that means that your after-tax value would be now $98,290, which is a decrease in your annual return by 1.71%, no matter if the investment went up or down in value. So let's just say that you invested $1,000 per month for 30 years, averaging 10% of an after-tax return. That would end with a portfolio worth over $2 million. But with a consistent tax drag like this, just to emphasize the difference, that means that the same scenario, you would instead average roughly an 8.3% after-tax annual return, which means your end portfolio would be $1.49 million, which is over $500,000 difference because you didn't understand the more tax-efficient investments. All in all, those were just simple numbers and not an exact representation, but the impact of tax costs from doing this can add up significantly over time. Where if you instead bought the ETF FMEG, the capital gains distributions were 0%, which the fund still paid a very small amount of dividends, but you can see that there was in fact zero short-term capital gains, and 0 long-term capital gains distributed to investors. So to compare the actual difference of $100,000 invested into either of these investments, including the dividends because they're also going to be triggered towards your taxes, for the mutual fund FMEGX, if you owned the fund throughout the entire year of 2023, that means that you would have triggered $1.44 divided by the average NAV price that was $11.18, and that means that as a whole in 2023, roughly 12.8% of your $100,000 investment would have forced $12,800 towards your taxable income. But to compare the exact same scenario, but now investing into the ETF version, you would instead have had a total distributions of 8 cents divided by the average NAV price that was $22.11. That means for the entire year of 2023, roughly 0.37% of your $100,000 investment would have forced $370 towards your taxable income, which was solely from dividend income, and the only way to avoid that is buying investments that pay out less or no dividends at all. But like I said, this isn't much of a worry with simple index funds because the Fidelity S&P 500 mutual fund FXAIX has not triggered any capital gains over the past few years, so this wouldn't even matter. Which Vanguard's S&P 500 mutual fund also has not triggered any capital gains. Where if we look at the small cap mutual fund on Fidelity FSSNX, you can see it recently had a few capital gains triggered, but that was also a few years ago, and it hasn't triggered any since December 2021. Looking at Fidelity's mid-cap, that is FSMDX, you can see in fact that it's had a few capital gains triggered, even just recently in December 2024, where if you instead purchase Vanguard's mid-cap ETF VO, you would have had no external capital gains triggered. So like I said, index mutual funds typically won't be a huge concern. I do believe that ETFs give you more control and are safer overall, especially in taxable accounts, but I don't think it's worth triggering significant capital gains to make the switch. And just so you are aware, here you can see some of the largest actively managed ETFs, and that none of these recently have had any capital gains distributions for investors. But be aware that ETFs could still distribute capital gains, although it's much more rare and less of an impact. If we look at the top one, that is JGLO, for the year 2024, it did create some gains for investors, but the total ended up equating to 1.3% that was forced. And although it is rare, if you are curious on the reason for why this could occur with ETFs, that would be if the authorized participant, the AP, is in need of cash rather than wanting to trade securities, which could be due to poor liquidity, certain guidelines or market rules, or a sudden disruption in the market. If you're curious to learn more and try things out, I'll have direct links below to many of the resources I've used for this video. With that said, here are my final thoughts to take forward. The first thing is to understand the long-term effects of not investing properly in taxable accounts, because the tax drag can add up significantly and you could easily be missing out on potential growth. Remember that especially with actively managed funds, not only are the mutual funds likely to trigger more taxes in taxable accounts, but they also have higher expense ratios than simple index funds, which an image right here shows a $100,000 investment with a high expense ratio and tax cost that could easily add up, where the example specifically shows it would affect your annual returns by 2.68%. And in fact, a $100,000 investment with a 2% tax drag could cost you $30,000 over 10 years. Just imagine after 30 years. Like I showed, the S&P 500 index mutual funds through Fidelity and Vanguard had no differences as far as tax distributions compared to the ETFs, but other options may vary slightly, and especially for the actively managed ones, I highly recommend to keep an eye out for that. My motto for this is that you would rather be safe than sorry. So if you are one looking to reduce as much tax drag as possible, you would ideally want to stick with ETFs in taxable accounts that mostly track US equities and target the ones with low dividends so that you can have as much control over the tax burden that you can. But if you own Fidelity's FMEGX in a taxable account or any of the other ones listed right here, I highly recommend to think things over before it's too late. Now, if you're interested to check out other videos I created, I'll have direct links to some of the most relevant ones that I think you could greatly benefit from linked in the description of this video. And while you're at it, if you want to learn more about building an investment portfolio or seeing my entire index fund cheat sheet, I'll leave these free learning guides that I've created linked below as well. And if you want to start investing on a new platform or check out other top financial products, I'll have direct links provided for you, which I will say, depending on what you get started with, I may earn a commission for it, which is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.